What's driving the property market insanity? Let's have a look. Hello everyone, Florian.Heise here and welcome to another episode of HeiseSays. Grab your stein of coffee, let's have a look at this article from realestate.com.au. So Australian housing, what's fueling the property market insanity and the possible impact of rising interest rates? Now there's more and more discussion of the fear of rising interest rates. Yesterday we had a look at a property shared by a viewer where McGrath were proudly showing off the fact that it was only on the market for under a month and a property that would have gone for 1.2 went for 1.7. I just got off the phone to a real estate friend here in Brisbane. I said, what's it like out there, mate? I'm hearing all these things. I'm reading all the media. What's going on? And he told me, recent example, a client wanted him to find a property. There was a house that someone bought for 800 grand just a couple of years ago. They did, probably chucked 100 grand at it to do it up a little bit. And they were going, they had 1.1, 1.15 to try and get in. And it went for 101.4 million. So they were trying to get it for 1,150,000 grand. It went for over 1.4. The market's going hot here. I think it depends on the area and the location as well. But, I mean, there you go, guys. There you go. And interest rate rises. I mean, our cash rate, everyone, we're far below emergency levels at 0.5. He was telling me he thinks what other agents are saying. People will jump in now. They'll borrow all this money. They'll buy these properties. And then 3 or 4 years' time, when rates start creeping up again, and when they are no longer able to service those loans, we're going to start to see these properties reappear on the market. Now, the question is, will they just drive inflation to the point where will wages actually go up? We had a look at a previous video where food could potentially skyrocket. And before we go into this, I want to show you one little thing, just people using Afterpay to buy off the plan. I think this is just this is insanity here. So, I mean, this is a property development, developers are selling, new home for $329,900. Now, I'm not a fan of buying off the plan. I would discourage you to do it. Just purely from the fact as an architect, okay? This is me speaking as an architect. When we are designing buildings, there's a lot of stuff going on. We need to work with a whole team of professionals to get a building to build. Now, to do a render like that, no, you don't. You can do that yourself. And you, as an architect, you'll make educated assumptions on, based on your experience in previous projects, on what needs to go where. How thick the walls are, how you'll transfer the structure down, and the aesthetics, the materiality. That's fine. You'll do that. And you'll generally get it pretty right. But what'll happen is once you get input from other consultants, things that you may have not considered or information you just didn't have at hand will influence the design. So it will change. That's natural. Because of doing a render, it takes a lot of work, but not as much as getting a whole team together. You've got an architect, you've got a structural engineer, you've got a certifier, you may even have an access consultant, you've got a hydraulic engineer, you'll have a mechanical engineer, you have a fire engineer. Who am I missing? You'll have a landscape architect. And they're just the ones I can think off the top of my head. Don't forget the electrical engineer, Florian. Yep, you've got to remember those. So you have all these consultants working together on just a simple building like this. And, oh, wait, I forgot geo. You may even have an archaeologist. You never know. All of these potential people will get their input. And that usually comes after you've bought off the plan. You just have to remember that. There will be changes. There will be changes. Okay? If you're willing to bear that, that's fine. But you need to understand what you're signing up to. But, I mean, that's the thing. And this one here, they've got it down the bottom here. Where is it? 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 Come on. Come on, where is it? I think I saw that before. Here we go. Here we go. Okay. 5% deposit not due until the 28th of February, or take advantage of the 6-month Afterpay option. So they're probably providing their own Afterpay. Because you could do like a $1 grand deposit and then you just pay it off over 6 months just to get in there. And you'll be waiting for it to get finished, everyone. So, I mean, there you go. There's an example of what I would say would be property insanity. So let's have a look. Let's have a look, everyone. So, record low interest rates have been fuel to Australia's red-hot property market. But the dream run on rates may be about to end, leaving some buyers exposed. Well, that's what they're saying. That's what they're saying. Let's have a look. We'll jump over here. We'll go to the ASX rate predictor. Let's see. What's the rate tracker saying today? The rate indicator on the 8th of March, 25% no change, 75% decreasing to 0%. So it's not predicting an increase. They're not even showing an increase. So the Reserve Bank looks likely to find itself under property price pressure a lot sooner than it had expected, with reports stating house prices climbed in February, said Canister Group Executive of Financial Services Steve Mickenbacker. But they don't care. The Reserve Bank don't care about house prices, everyone. They care about employment. It's not part of their mandate. It's not. If it was part of their mandate, you think would be in this situation. I mean, here we go. Yeah, we saw this about the people that were camping out to get land. We talked about that a few days ago, and I was... Apparently, what I consider a $15,000 trailer with a bit of stuff on there is more like 50 grand. So I'm out of date, guys. I'm just out of date. You know. In 2020, Reserve Bank Governor Philip Lowe said interest rates would likely remain at 0.25% for years. Then they dropped as low as 0.1%. His argument was that the unemployment rate would need to fall to around 4.5% and inflation should be sitting at 2 to 3% before rates would head north. I think it's reasonable to expect that will not be for some years, he said. However, Australia's unemployment rate is already falling, dropping from 6.6 to 6.4% by January. The economy is booming and dwelling prices are soaring. The economy is being propped up. You've got JobKeeper, still in existence. You've got Job Seeker Bonus, still in existence. You've got mortgage holidays, still around. You've got the ramifications of trading while insolvent, haven't been manifest yet. We haven't returned to average levels of insolvency. So, is it a boom? Or is it just an economy that's been juiced up through government stimulus and people forced to save because they couldn't do anything? Oh no. What if the government gets this brilliant idea as a way to juice up the housing market is to have forced lockdowns, rolling lockdowns every 6 months. So then people can't go spending. You think I'm joking? They might do it. It's for housing. For housing. Sacrifice for housing. You need to, you know, work in the crap job for housing. I've been doing this too long now. The Reserve Bank doesn't expect to raise the cash rates for 3 years or more. But unless property prices can be slowed, it will start looking for some way to apply the brakes, he said. The perfect storm. New listings throughout 2020 were at 4-year lows, according to Mr. Mickenbacker, meaning there just isn't enough stock on the market. I mean, that's the thing. Why would you... You know, here's the thing, you can sell and then you're screwed trying to find something. Because selling, you got all these costs. You got agents, lawyers, stamp duty, moving costs. You got to clean your house really well. You got to, you know, it's not fun. Property demand has run way ahead. With the fear of missing out, that's it, media, becoming a powerful psychological driver as government incentives and low interest rates have encouraged first home buyers and home buyers into the market in a rush, he said. The result of slow supply and increased demand is a timing mismatch. Market forces must eventually slow the pace of demand, but we're going to have to see an increase in property listings to get us to that point. Supply must come from investors who will be feeling the heat as first home buyers leave a further vacancy behind, but investors can walk away with a tidy capital gain and no pressing housing needs, he said. Buyers will be feeling a lot of pressure before this all plays out, and the Reserve Bank will be looking for a circuit breaker, he said. What goes down must go up. Anyone who entered a mortgage in recent years would have felt the positive effects of falling interest rates, but considering the typical house loan lasts 30 years, there is every chance that rates could climb much higher during the life of the loan. Canstar has crunched the numbers, and just 10 years ago, the average variable rate sat at 7.22%. The heftier rate on a 500 grand loan would mean $3,397 a month, far from the $1,800 repayments in present day. There you go. When they're down at 2%. I mean, think about that. That's going to be the thing. If you're doubling, if we hit at 7% and your mortgage doubles, can you pay it? There'll be a lot of people that will then enter mortgage stress for the first time, but there are people who are in mortgage stress now, spending about 30% of their pre-tax income on it, the gross income on their mortgage. Imagine that if it doubled. Sure, you can make cuts to your life expenses. Maybe that, you go really hard. Gonisby, chief economist of realestate.com.au, said people need to be mindful that interest rates can go up quickly. It's like house prices. When they're falling, people think they'll fall for ages, but then suddenly they can shoot up again. The same thing can happen when interest rates. People need to be prepared and put in place a buffer so they don't find themselves getting into distress, she said. And this is the problem. How many people are borrowing at the edge, are going beyond what they could expect? And we haven't even seen, remember, the economy is still being held on life support due to all this intervention. When that disappears, what's going to happen? So Billy Christophe is finance director with Reventon and has 21 properties. She said suave investors should plan for the eventuality of raising rates by going above and beyond the 2.5% serviceability buffer banks calculate when lending. Those buffers are great because they take into consideration changes to your living expenses and cater for changes in the interest rates. But I advise people put buffers in other areas as well, she said. Well, food's going to get more expensive. We'll see that. Put a buffer in the vacancy rate of your investment property. Don't expect it to be rented out 52 weeks a year. Put a 10% buffer in there as well. She added that even if interest rates do start to creep up, it's not all negative. If they do rise 4 or 5 years down the track, you need to take into consideration that rents will increase too, she explained. So plan for interest rate rises, but know that circumstances do change in your favor as well. Also, if it's an investment property, that interest you're paying is tax deductible. It's an alternative scenario. I think we've still got at least a couple of years where interest rates are going to be quite stable. Right now is still a really good time to get in the property market, and if you feel uncertain about what's going to happen with interest rates, look at fixing your loan instead of keeping it variable, she said. Before the RBA increases interest rates, Ms. Gonisby said there could be other initial steps taken. This could include a return to greater scrutiny on tax incentives, and maybe negative gearing might come up as a hot topic again. Probably a lot of first home buyer grants will also be reviewed over the coming 12 months, she said. There might also be a focus on the responsible lending rules that were previously relaxed. When they eased up, it was much easier to get finance, and banks started offering a lot of incentives, not just low interest rates. I think if the RBA is right, and they don't believe inflation will take off for a few years, then it will be some other form of intervention that we'll be looking at to slow things down. So there we have it, everyone. The current property market insanity. What's driving it? And using Afterpay to get into those off-the-plan properties. Nothing could go wrong, mate. She'll be right. As always, thanks for watching. Like, share, subscribe to the channel. Let me know your thoughts and opinions in the comments down below. If you're a fan of the channel and enjoy my content, there's a few ways you can support us. You can join us on YouTube or Patreon. You can support us using our affiliate links from Amazon, eBay, Independent Reserve, or AussieBroadband. You can buy my merch from HeiseSays, use Gold Pass from the Perth Mint, or support us via PayPal. Take care, have a great day. I will see you next time. Bye for now.